Good afternoon, everyone, and welcome to our webinar. My name is Alistair Dent. Joining us on the webinar today is Jonathan Tiefel. Really appreciate everyone giving up their time to attend our session this afternoon. We've got a fairly full session. We should wrap up close on 1 o'clock Sydney time. The topic of business valuation certainly seems to have piqued some interest, which is really great to see. I think we've got a couple of handfuls of overseas attendees on the call today, including the Americas and the UK and others in New Zealand. So welcome all. We're very thankful to have you all with us, and we trust you'll all get some value out of our presentation. And with that, I'll hand over to Jonathan to kick us off.
Okay, thanks, Alistair. So before we start, just a very brief background on who we are. Quantum Advisory is a business advisory and accounting firm. We're based in New South Wales, Australia, with offices in Windsor and Wollongong, and we service clients right around the country. We have clients in every state of Australia, and our core focus is on growth businesses. So rather than just tax and compliance, as you can see by our mission statement there, we're focused on growth businesses. So just before we get into it, we'd just like to share with our clients that we're soon to launch Metric, which is our business intelligence division. Metric will offer advanced business intelligence to help you drive better business decisions, and this will include services such as industry benchmarking, business valuations, risk assessments, and a whole heap more. So keep your ear to the ground, and you'll get further updates on that in coming weeks. So today's topic is a very important one, and one that I believe that every business owner needs to have front of mind. Unfortunately, that often isn't the case, and as a result, you see large chunks of value in a business that are often left unrealised. So the central premise to what we're saying today is that if you want to grow the value of your business, it needs to be by design and not by default. So that's why we have the title of this webinar today, and that's Planning to Win Surefire Strategies to Boost the Value of Your Business. So before we begin, just a quick run through of today's agenda. So today we'll be looking at what your business is worth, so a bit of an overview on business valuations and how it relates to your business. We'll discuss why you need to be thinking about your business value now, even if you're not planning on selling. And then we'll have a bit of a look at the different business valuation methods. We'll also cover the main elements of business value and how they all work together. And finally, we'll spend some time giving you the main strategies that you can use to boost value of your business. So there's plenty of meat in today's content, and hopefully we can hold your attention for the next 30 minutes or so. And as always, we really appreciate your feedback. So you'll see a feedback form pop up at the end of today's session. If you can fill out the form, we'll make the slides available to you. We'll also make available our business value drivers cheat sheet. And with that, I'll hand you back to Alistair.
Thanks, Jonathan. So here's a question for you. What is your business worth? Do you have any idea at all? Most of the business owners that I speak to actually don't. So we're going to kick this section off with a quick poll. Hopefully we can find out how many of you actually know what your business is worth. So you'll see it on your screen there. Just please select the option that best describes your situation, and we'll share the results shortly. So when we talk business value, we're not talking about what your business is worth to you. We're talking actual transferable value, and that is what someone would reasonably be prepared to pay you for your business. So we're just seeing those results come in now. Interesting spread of results there. We'll just leave the poll open just for another couple of seconds, and we'll close that and share the results. Okay, so we can see the results there on the screen. 22% have absolutely no idea what their business is worth. 30% not much better. 41% have a reasonable idea, and next to nothing in the next two categories. So very interesting results, and really tell the picture, I guess, of what we see day to day, and that is the business owners don't have a clear picture of what their business is worth. So why is it important to know what your business is worth? Well, I'm guessing you know what your house is worth and how much you have in the bank. Other investments that you have, you pretty much know what they're worth. But what is your most valuable asset? Well, more than likely it's your business. So surely it then makes sense to know the value of it. Because if you don't know what your business is worth, you really have no idea what your net worth is either. So what we'd like to make clear now is that maximising the value of your business doesn't just happen automatically. It actually takes planning. As we said earlier, it should be by design rather than by default. You may have seen a book called Built to Sell by John Warrillow. If you haven't read it, I recommend that you do. Very interesting read. And what we'd like to convey is that building your business to sell not only increases its future sale value, but it'll also increase the profitability and the viability as well. You must be building your business as though you intend to sell it, even if you have no plans to do so. That's why you need a long-term view rather than a short-term focus.
Okay, so I guess it really points up the whole point of important versus urgent. So the urgency of short-term profitability always seems to take priority over the importance of the long-term business value. So you can be working too hard to achieve better profits, and sometimes it's hard to see that could actually be at the expense of long-term value. In our experience, it's less than 10% of business sales that happen in a controlled circumstance. By that I mean that really it's only 1 in 10 business owners that actually implement a program of value improvement prior to selling their business. And trying to increase the value of your business when you want to go to sell it is really too late. So the point is here that you need to be starting now. You need to be starting today. Okay, so now we're just going to have a quick look at different valuation methods. So there's 4 typical valuation methods used here in Australia, in fact, around the world. And we're going to have a brief look at each of them. We're not going to spend too much time on the first 3. That's because the 4th method is by far the most common valuation method used for small and medium enterprise. And to do that, I'll hand you back to Alistair to run through those.
Thanks, Jonathan. So the first method is discounted cash flow, and then we can see the other 3 methods after that. We'll run through them each very briefly. So the DCF method uses future free cash flow projections and then discounts them to arrive at a present value estimate. This method is really not that common, and it's only suitable when future cash flows can be accurately predicted, generally not used for small and medium businesses. Second method is the market-based method, otherwise known as the comparable transactions method, and this values a business based on pricing multiples that have been taken from recent similar business sales. So essentially comparing the value of other businesses that have recently sold to arrive at a value. Main reason that this method isn't common for small and medium enterprise is that really sales data from similar private business sales is actually hard to come by. Third method is the asset-based method, and an asset-based valuation focuses only on the net assets of the business. So this method is used when other valuation methods really give a value that is less than the net tangible assets of a business. And so there's generally no goodwill component in an asset-based valuation, typically used for poor performing businesses. Finally, the future maintainable earnings method, the FME method, most common method for valuing profitable businesses here in Australia, also known as the return on investment or the ROI method, or sometimes capitalised future earnings method. We'll discuss this method in more detail a little bit later, but here is a very, very basic example of how it works. So you can see we start with a net profit from the most recent financial year, 650,000. Then we take the EBITDA add-backs, what we call the EBITDA add-backs. That is amortisation, depreciation, and interest. And then we take that profit and normalise it. So normalisation adjustments typically include things like owners' wages, any abnormal expenses. That will then give us what we call a future maintainable earnings number. There on the screen we can see that it's $900,000. The earnings multiple, which is probably the most critical factor of a business valuation, is sitting there at 4. So 900,000 by the multiple of 4 gives what we call an enterprise value of $3.6 million. So from there, we need to look at the elements that are in a business valuation and also what we can do to leverage them individually. So the first and fundamental principle to get your head around when it comes to business valuations is risk versus reward. And that's a real balancing act to actually drive your business valuation. Everything that impacts the value of a business hinges off this core principle. So the reward is the financial return that a business will generate, so profits and cash flow, and the risk is the level of risk associated with the generation of that reward. So in short, higher reward and lower risk equals more value, and then conversely, lower reward, higher risk equals less value. So EBITDA is the most common, I guess, earnings measure for calculating business value. It means earnings before interest, tax, depreciation and amortisation. And typically there are normalisations that need to be taken into account to arrive at a genuine EBITDA number. These include such things as normalised wages to a commercial level, so typically owners' wages, commercialising that wage level, includes discretionary expenses such as donations, any once-off or non-recurring expenses or income, and any non-operational expenses or income, so anything that's not directly connected to the operations of the business. So once EBITDA is normalised, we arrive at that figure, which is called the future maintainable earnings. The second part of the business valuation is then the earnings multiple, or as we said earlier, sometimes it's called the capitalisation rate. And typically this can vary anywhere from perhaps 2 to say 12, but it normally sits somewhere in the range of around 3 to maybe 7. And ultimately, risk is the factor that determines the earnings multiple. And so if you can lower the risk, the multiple will rise. Conversely, higher risk means the multiple goes down. We'll discuss in more detail shortly, but there we have it, the very basic formula. Future maintainable earnings by the earnings multiple will give you your enterprise value. So your enterprise value perhaps shouldn't be confused with business value, although sometimes they are the same thing, but we won't go into the technicalities of the terminology. But enterprise value includes more than just the goodwill. It would typically include working capital, so the debtors and creditors and stock of the business. It would include the fixed assets, so typically vehicles and plant and equipment. It would also include the intangible assets, so the goodwill and the intellectual property of the business. And the balancing number will always be the intangible assets, so the goodwill. So the fixed assets and the working capital, the values of those are quite easily arrived at, and the balancing number, therefore, will always be the goodwill, and that is the number that will go up and down. So just to demonstrate that, we're just going to run quickly through 2 enterprise value scenarios, both with the same enterprise value of 3.6 million. So in the first scenario, we've got fixed assets of 1.2 million, we've got debtors of 800, a stock of 1 million, and creditors of 500,000. So when we take those numbers into account, the balancing goodwill number is 1.1 million. All right, now the exact same business with the exact same enterprise value in a different scenario can give a different goodwill result. So if our fixed assets are perhaps more efficient and we only need 1 million instead of 1.2, we collect our debtors a little bit faster, so they're at 700 instead of 800, and our stock turn is more effective, and we only need 800,000 versus 1 million. We've simply increased our goodwill number by $500,000 from 1.1 to 1.6 million. So you can see that it's very critical to have a good understanding of what actually makes up that enterprise value. Right, and with that, I'm going to hand back to Jonathan, and he can run through the value drivers that have an impact on your business value.
Okay, so what we're going to run through now is our 10 drivers of business value. To really maximise business value, you can't just focus on one or two of these. Think about it like a decathlon, as you're maybe familiar with. It's an athletics event that involves 10 different disciplines. If you're really good at, say, just running or high jump, that's no good, and no good at the rest, then that's really no good in terms of winning the overall prize. So here we go. We're going to jump into the first one, which is financial. And this is first because it really is the most important. Profitability is absolutely critical to the value of a business, as is the history of profitability. So if you have a solid history of profitability in your business, that implies stability, therefore less risk for a potential buyer. Financial trends are also absolutely vital. So a business with positive financial trends will command a much higher multiple than one with trends that tend to be declining. Financial record keeping is absolutely critical. It's very, very important to have good financial records. Poor financial records will be an obvious risk to any potential buyer. So really you really need to be thinking about strategies around your financial processes and how you can perhaps minimize any unnecessary expenses, how you can improve the quality of your record keeping, and identify any of those negative trends in your business and start implementing strategies on how you can potentially turn those around. So the second key driver is growth, and as we've said, as Alice has gone over, although a business is generally valued on historical profits, it's the future revenue and potential profits that a potential buyer is buying. So you need to be able to demonstrate that you do have a blue sky business. You need to be able to demonstrate the fact that the business does have solid potential for growth. If you've got any guaranteed income, that will lower your risk and demonstrate the further possibility of growth. So think of any contracts that you may have or forward orders, any recurring revenue streams that you may have, and start looking at strategies that you can start to implement that will help you articulate the fact that you do have a strategy there for growth. So do you have a plan to develop future markets, perhaps some additional products? Have you got any plan to perhaps modify any current pricing structures to generate recurring income? Because obviously this will help drive the value of your business. The third driver is independence. Sorry about that. So you need to look at your business and consider how your business treats cash. What's its appetite for cash? Is it a cash cow or is it a black hole? And by that I mean, does it generate cash or does it really suck cash as it's growing? So your working capital ratio is critical to monitor. You obviously need to be looking at what cash your business is using to fund growth, because obviously a business that can fund growth from its profits will have a much lower risk and therefore a much higher multiple. So the fourth point is independence, and this is a critical concept for business owners to get their head around, and it's really looking at, is your business too dependent on any one stakeholder? because if it is, this can be a real risk. So you need to look at owners. Are they too vital to the success of a business? Is the business too owner-driven? You need to look at employees. Are there any key employees that the business couldn't do without? What about customers? Are there any customers making up, say, 5% or more of your revenue? What about suppliers? Are there any key suppliers that you have that you don't really have a plan B for? And what about products? Are you relying on one particular product line or one particular product in your business? You need to really identify any of these discrepancies and work to remove them. And point number 5 is systems. So really, how well oiled is your machine? Businesses that can run with systems rather than with reliance on individuals are more profitable and therefore more valuable. So a business with good systems in place will attract a higher multiple and also will attract a potential purchaser. So you need to be looking at things such as your financial systems, how good are they, also all your operational systems and processes, right down to your administration processes, how good are they, also your management systems as well. So as a strategy, you need to be looking at having a well-documented system and a process for absolutely everything in your business. And I'll hand you over to Alistair to run through the next part.
Thanks, Jonathan. So the 6th value driver is capital, and this is an important point to understand. What are the capital requirements of your business? So when we talk capital, we're talking both working capital and also fixed assets. And higher capital requirements, businesses that are more capital intensive, it will mean not only a lower goodwill number, it will also have a negative impact on your multiple. So if your business has got a higher requirement for investment in equipment, perhaps premises, and certainly an investment in working capital, if your working capital is not efficient, this will definitely impact your multiple. So you need to review your capital investment to ensure that you're not over-investing in your business. So a good measure to look at is the return on capital that is employed within your business. Driver number 7 is brand, which is perhaps a fairly intangible thing, but it is absolutely critical. So brand recognition in particular and brand loyalty, so customer loyalty to your brand, is absolutely critical to drive up the multiple in your business valuation. So looking at any intellectual property that might hang off the back of that, so we're talking trademarks, patents, any IP in that regard will help strengthen your brand and therefore lower the risk and drive up your multiple. Driver number 8 is people, which is perhaps a little obvious. However, as Jonathan said earlier, we've got to make sure that we don't have dependence on, or too high a dependence on any one particular individual. But on the flip side, we do have to have a high-performing team, and not just a team of high performers. So the engagement level of the people within your business will without doubt have an impact on the multiple that your business will gain. So if you've got a business where your team is perhaps not very engaged, if you've got a high staff turnover ratio, no question at all, this will have an impact on the multiple that you will be able to achieve. Number 9 is market. So what is the market position of your business? So not only the position that your business has within that market, but also what is the situation of the overall market? Is it climbing or is it declining? What's the level of competition? And also, what are the barriers to entry? So if the market that you occupy has a high barrier to entry, that is new entrants, new competitors find it difficult to enter, that will have an impact on your multiple. So what can you do to ensure the protection of your position in the market and also the future viability of your business model? So we need to be looking ahead. And then finally, differentiation, absolutely key. So do you have a USP, and is it really a genuine USP, so a unique selling proposition? Are your products differentiated, or are they just the same as your competition? Are you competing on price? Do you have any proprietary products or processes or systems that help differentiate you from the competition? So review your competitive advantages, seek to strengthen them, and absolutely widen the gap of differentiation wherever possible. That will help drive the multiple up. So there we have it. As Jonathan said, don't just focus on one area. Recognise you can't do everything at once. Building business value, it actually takes time. It takes a strategy. So have a plan and implement that plan step by step, and without question, you will reap the rewards in the future. So let's look at what we've learned today, going over what your business is worth. We've looked at why a business valuation is important, and why you need to understand what your business value is on an ongoing basis. And then secondly, having a plan to actually drive the value of your business up. The importance of the long-term game. We had a look at the overview of valuation methods. So we looked at the 4 methods there. That was the discounted cash flow method. We looked at the assets method, and we also looked at the we looked at the future maintainable earnings method, which, as we said, is certainly the most common business valuation method in use here in Australia today. Finally, we looked at the elements that make up the business value or the enterprise value, and what you can do to leverage each of those individual elements to not only improve the value, but also improve your goodwill return. And then finally, the different value drivers that actually have an impact on business value, and what you can do to use those and boosting your business value. So to wrap up, at the finalisation of this session, you will see a feedback form pop up. I would be very glad if you could fill that out. We'll also be able to supply you the slides, and for anybody that fills out the feedback form, we'll also supply the 10 business value drivers cheat sheet. And so to wrap up now, once again, thanks very much for your time. We'd be glad if you could join us again next month. Thank you.